Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing you want to do is just open up any equities underlying. We've got Docu up at the moment. Anyone will do, and you want to navigate to a list of expiration dates. The expiration date that you want to lock in on needs to be between 30 and 60 days out in time. It also needs to be a monthly, not a weekly or quarterly expiration. The only expiration date that fits that criteria as of right now is January 17th, which is 55 days out in time. So we could take that information, come over to our watch list, and simply filter out any underlying that has earnings over the next 55 days. The reason for this is simply because we do not want earnings to come along and disrupt our trade. It will increase volatility, mess up our deltas, and all of these things will have a negative effect on your P&L. And you also want to remove anything that has a low liquidity rating level, and you'll be left with something that looks like this. Of course, it depends on your specific watch list. This is just a pre-made one. I personally like to order everything from high to low IVR. We want to sell or short when IV is high or when volatility is high, and then play the contraction back down to the mean. Volatility is mean reverting. The market is closed right now. It's a Saturday, but we're just going to mock up a position just to show you an example. And you also want to keep in mind what's already in your portfolio. If you're very heavy in any one sector, try and keep it diverse. Use common sense, and you'll be fine. And you just want to go down the list and just see what catches your eye. So this is just simply a small example portfolio. We have already got a position on UAL. BA is looking quite nice. Of course, if this was your actual real portfolio where the majority of your funds are, you would not be looking to put on a position on BA if your only other position is UAL. But for this example, it's fine. BA is currently trading at just under $150 a share. It's got an IV rank of 46.6, and it's got an absolute IV level of just under 36%. So if you come into BA, open up the January 17th expiration date. At this point, you just want to do what we always do, is simply sell one call and one put. We want to sell them anywhere between a 15 and 20 delta. So we've got a 20 delta on the call side, and then we've also got a 20 delta on the put side. So we've essentially created a range for ourselves here between the 135 and the 170 strikes. We would collect $473 upfront in premium, and our broker is going to require just under 1.6k in buying power to open this position. So for a naked position, this is a very, very good and healthy return on capital. And you have a 67% probability of profit. And if you wanted to get out of this position at 50% of max profit, you've got an 82% chance of that happening. So very, very high probabilities of success. But for any reason, if 1.6k was a little bit too much for your account, you can simply just buy a contract a little bit further out, say $5 wide on either side. And that's going to significantly reduce your buying power requirement because you no longer have an unlimited loss potential. Your max loss is now defined. And your return on capital will generally be higher with a covered position. Although you will collect less upfront, but your return will be higher in terms of the amount of buying power that you have to put up. You will also have slightly lower probabilities of success as well. That's just the nature of a covered position because you're collecting less premium, so your break-even points aren't as wide. So how do you know how much buying power you should be allocating to any given position? Well, we've got a free position sizing template that's available for anyone to use and get hold of. Click the link in the description and then head on over to the free position sizing template. The way it works is you enter in the size of your portfolio, and then you enter in what the current VIX level is, and then below that, everything will then be automatically calculated for you. And at this point, all you have to do is use this information to form the backbone of your portfolio, and over the long term, you'll be just fine. If you want to learn in more detail about what we're doing behind the scenes, again, link in description. This time, click on EDS Premium. Get yourself signed up, and once you're inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. There's a full course as well, so no prior knowledge is required. We will teach you everything that you need to know. It's a private community, so you can speak with other like-minded individuals and with myself directly. There's also a 100% money back guarantee. So if after 6 months you followed our trades and you haven't seen results and also gone through the full course, then we will work with you for free until you do, until you are profitable, or you can simply request a full refund. So it's completely risk-free. Right now, it is only £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. With that being said, I will see you guys on the inside.